Imagine a standard corrugated metal commercial shipping container.
Right, like the ones you see on cargo ships.
Exactly. Or, being hauled down the interstate on an 18-wheeler.
Mm-hmm.
You assume it's holding, I don't know, flat-screen TVs or fast fashion.
Sure.
But then at a moment's notice, the roof of this mundane box flips open, and a swarm of hypersonic strike munitions launches vertically into the sky.
Wow.
Yeah, and they coordinate midair to neutralize an incoming threat. And if you ask who built something like that, it's actually the exact same company the Pentagon used to hire to fix their IT help desk.
I mean, that really forces a complete recalibration of how we categorize these massive government contractors.
It really does.
Because you look at that shipping container scenario, which is a very real program, by the way, and you realize this isn't just about managing databases anymore. This is about rewriting the physical and digital architecture of modern warfare.
Welcome to Griffonomics. Today we're diving into Leidos, trading under the ticker LDS.
Glad to be here for this one.
So, if your mental model of Leidos is still stuck in the early 2010s, if you still picture a guy in a short-sleeve button-down coming in to update some legacy servers and sending a bill, you are missing one of the most aggressive corporate evolutions happening in the market today.
Yeah, that old image is completely obsolete.
Right. Think of the old Leidos as the neighborhood IT guy. The new Leidos is operating a lot more like Tony Stark.
I like that analogy.
I mean, we're looking at a company building hypersonic glide test beds, developing sovereign AI cybersecurity networks, and literally designing autonomous warships.
And their CEO, Tom Bell, he's calling this their North Star 2030 strategy.
North Star 2030, okay.
Yeah, it's this highly deliberate, highly profitable portfolio transformation. They are prioritizing high-rate defense technology, sovereign artificial intelligence, and space-sensing payloads over commoditized IT services.
Leaving all that low-margin stuff in the rearview mirror.
Exactly. They recognized that just keeping the lights on for government agencies, it wasn't going to drive the kind of enterprise value they wanted.
So what we have here is an accelerating low capital intensity cash flow compounding engine. A company essentially building the nervous system and the muscle of the future military.
That's a great way to put it.
But, and here is the massive narrative tension that sets up our mission for today. If you look at the stock chart earlier this year, Leidos suffered an absolutely brutal slide.
Oh, it was...
They hit a 52-week high of $205.77, and then the floor just seemingly gave out. The stock slid all the way down into the $98 to $103 range.
And a drop like that for a major defense prime, it's jarring.
Right.
You don't usually see that level of volatility unless a flagship program is canceled or there's a catastrophic structural failure.
But that wasn't the case here, right?
No, not at all. It was driven by near-term headline noise. Specifically, they hit some temporary administrative headwinds and volume share dilution in their health segment.
Yeah.
The broader market basically took a localized, highly specific administrative issue in one division and extrapolated it as a systemic failure across the entire enterprise.
Which means we need to do some serious investigating for you, the listener. Our mission for this deep dive is to conduct a strict forensic audit of Leidos' Q2 2026 earnings.
We need to see if the market severely mispriced this defense giant during that summer panic.
Exactly. We've got a massive stack of sources today. Earnings transcripts, financial statements, analyst notes from major banks. And to prove whether this Tony Stark transformation is actually showing up in the bank account, we need to dive straight into this Q2 financial scorecard.
Because the numbers they reported on August 4th, 2026, they actually triggered an immediate 11% single-day stock surge.
11% in one day for a prime contractor is huge. Let's pull those numbers apart, starting with the top line.
So they posted record net revenues of $4.56 billion for the quarter.
$4.56 billion.
Yeah, which represents 7.2% total growth year over year. But the metric that really matters to allocators here is that 3.9% of that was purely organic growth.
Okay, let's stop right there and translate that for a second. For a company doing over $18 billion a year in total revenue, adding 7% in a single quarter isn't like a startup adding 7%.
No, it's massive.
We're talking about hundreds of millions of actual dollars in new top-line growth. And organic growth means they didn't just, buy a company to inflate the numbers.
Right. Their existing core business generated that expansion. It shows the underlying demand for their specific services is expanding.
Right.
But the revenue is only part of the story. The bottom line is where Wall Street really recognized the leverage of this North Star 2030 strategy.
Okay, hit me with the profitability metrics.
So they delivered an adjusted EBITDA of $631 million. That allows them to maintain a 13.8% margin.
13.8%?
Yeah, which sits comfortably as best in class for this tier of defense integrators. And their non-GAAP diluted earnings per share came in at $3.26.
Which beat expectations.
Completely crushed them. It beat the Wall Street consensus by 35 cents.
Okay, I am going to throw a massive red flag on the play here.
I figured you might.
You're quoting these non-GAAP numbers. Adjusted EBITDA, non-GAAP EPS. These are numbers that management gets to massage before presenting them to the public, right?
That's a fair critique.
Because if we look at the actual GAAP net income, the raw accounting math that you can't really hide from it actually fell 9% year over year, down to $356 million.
It did.
I mean, every company on Earth claims their adjustments are just, one-time costs. Why should we believe Leidos? Are we sure management isn't using adjusted EBITDA as a smokescreen here?
Your skepticism is entirely warranted. Whenever GAAP and non-GAAP diverge that significantly, you have to look at the bridge between the two. You have to audit the specific deductions.
What were the deductions?
In this quarter, the GAAP net income was dragged down by $29 million in very specific non-operational costs. When you dig into the filings, these aren't recurring operational leaks.
Okay.
They fall into three distinct buckets that are genuinely transitional.
Walk me through those buckets. What cost them $29 million?
First, you have the costs associated with their $141 million acquisition of Entrust Solutions Group.
Right, because buying a company isn't free.
Exactly. You pay investment bankers, corporate lawyers, integration consultants, IT merging costs. All of that hits the quarter.
Okay, that makes sense. What's the second bucket?
Second, they have costs for spinning up a pending Security Enterprise Solutions joint venture with Analogic Corporation.
Setting up a joint venture is a huge legal headache, I assume.
Massive legal and structural formatting costs, yeah. And third, you have the restructuring costs directly tied to that North Star 2030 corporate realignment.
Meaning severance packages for executives in legacy IT divisions, lease terminations on office space they don't need anymore, that sort of thing?
That is the core of it, yes.
Yeah.
They are paying the one-time tolls to restructure the highway.
Okay, I see.
Wall Street analysts look past those specific GAAP deductions because they represent structural investments in the future shape of the company. It's not a failure to profitably execute their current contracts.
Once those systems are integrated, those costs just vanish.
Exactly. The underlying cash-generating power of the ongoing business remains. And that underlying power is what gave management the confidence to not just beat Q2, but raise their full-year guidance.
The guidance raise is what caught my eye. They raised the revenue midpoint by $100 million, bringing the full-year target to between $18.20 and $18.40 billion.
And they bumped the EPS midpoint up by 5 cents, too.
But to really understand how a beast this large maneuvers, we have to look under the hood at the specific segment dynamics. Because it seems like a massive tale of two cities inside Leidos right now.
Let's start with the star performer, the Homeland segment. This division saw a level of expansion you just rarely see in mature government contracting.
How big was the jump?
Revenue soared 32% year over year, hitting $1.02 billion. And even if you strip out the revenue brought in by that Entrust acquisition, the organic growth was still 15.1%.
Wait, what is Homeland selling that is growing 15% organically? We always think of defense as, tanks and planes.
Right, but Homeland Security is a totally different beast. The growth drivers here are fascinating because they extend far beyond traditional Pentagon budgets.
Like what?
A massive piece of this growth stems from domestic and international air traffic management. Leidos is fundamentally modernizing how the skies are navigated, replacing legacy radar systems with data-driven tracking.
Oh, wow. I wouldn't have guessed air traffic control.
Add to that a massive surge in demand for commercial energy infrastructure modernization.
Energy infrastructure, like upgrading the power grid.
Exactly. The national grid is aging rapidly, and it's highly vulnerable to physical and cyber attacks. That Entrust acquisition was specifically targeted to bolster Leidos' capabilities there.
So they're securing the power distribution networks.
Yes. And furthermore, the non-GAAP operating margins in the Homeland segment expanded by 280 basis points, jumping to 12.1%.
Okay, let's translate those basis points for a second.
Good idea.
Because financial jargon can obscure the real-world impact. A 280 basis point expansion means that for every $100 Leidos brings in through the Homeland division, They're keeping $2.80 more in pure operating profit than they did last year.
Correct.
In a billion-dollar segment, that is a mountain of newly found cash. How did they wring that much extra profit out of the system?
It comes down to a favorable shift in the security product mix. They're selling more high-margin software and integration services compared to lower-margin hardware.
Software scales better.
Vastly better cost absorption as they scale. When you build a software architecture once, deploying it to the 10th client costs almost nothing compared to the first.
Makes total sense.
Meanwhile, you have the intelligence and digital segment, which is their largest division by sheer volume. They pulled in $1.5 billion in revenue and held a very steady, reliable 10.1% margin.
So if we look at the enterprise outside of the health division, the rest of Leidos is projected to grow roughly 7% in revenue and a massive 19% in adjusted EBITDA organically.
The structural engine outside of health is accelerating rapidly.
And this is a massive multi-billion-dollar but we have to turn our magnifying glass directly onto the crisis in the health segment.
We do.
Because if Homeland is growing organically by 15% and intelligence is stable, why did the stock crater earlier in the year? We need to unpack this localized panic.
We have to reconcile the numbers first. The health segment saw its revenue contract by 7.6%, falling to $1.68 billion.
Down to $1.68 billion.
Yeah, and they have a planned margin contraction down to about 23%.
Let's keep some perspective, though. A 23% operating margin is still wildly profitable.
Oh, absolutely.
Most companies would kill for a 23% margin, but the market hates contraction. What were the administrative headwinds dragging this down?
Two primary culprits. The first is volume share dilution. Leidos operates a massive subsidiary called QTC, which is a dominant player in the Veterans Benefits Administration, or VBA medical disability exam contract.
This is a logistics operation of immense scale, right?
Massive scale. They manage a network of 15,000 providers across 90 clinics, doing roughly 2.8 million medical exams annually for veterans.
2.8 million exams. Just coordinating the scheduling and medical records for that is mind-boggling.
It requires a massive technological backend. But recently, the VBA decided to fully incorporate a fourth vendor onto this regional contract.
Okay, I see where this is going.
Think of it like a pie. If you were previously slicing the pie 3 ways and now you have to slice it 4 ways, Leidos' overall volume of exams naturally dilutes.
Fewer exams processed means less revenue billed.
Exactly.
That explains the revenue dip to $1.68 billion. But what about the margin contraction? Why did the profitability shrink?
That leads to the second culprit, which is what really ignited the market panic. In May 2026, the VA abruptly announced they were pausing vendor performance incentive payments for the rest of the calendar year.
Wait, they just halted the incentive payments entirely?
Yep.
That feels like your boss walking into your office and saying, hey, you know that year-end bonus you usually get for hitting all your performance metrics? We are suspending that while HR audits our payroll software.
That analogy hits the nail on the head.
It obviously hurts your take-home pay this year, but it doesn't mean your base salary is permanently cut. Is that a fair way to look at it?
Very fair. The VA is conducting internal administrative and auditability reviews regarding how these performance incentives have been historically structured across all vendors.
So they hit pause to do paperwork.
Right. But if you read the transcripts from the earnings call, the fear from the analyst community was palpable.
Oh, I bet.
You had analysts worrying this wasn't just a temporary pause. The fear was that the VA was using this audit to permanently reset the margin structure for the entire health segment. A permanent cut to a 23% margin business would be disastrous for the long-term cash flow model. How did CDO Tom Bell defend against that narrative?
He took a very firm stance based on direct conversations with VA leadership. He clarified 2 things. First, this incentive pause is strictly for 2026.
Just 1 year?
Exactly. The VA remains deeply focused on quality and timeliness, which are the exact metrics those pause incentives reward.
Yeah.
You can't demand high performance and permanently remove the financial incentive.
True.
But the second point, and this is the critical piece for allocators, is that the loss of these 2026 incentives is 100% incorporated into the newly raised full-year guidance.
Let me make sure I'm fully grasping the math here. They lost their performance bonuses for the rest of the year in what is historically their highest margin division.
Yes.
And despite that massive hit, they still had the financial firepower to raise the profit guidance for the entire $18 billion enterprise. It perfectly illustrates the strength of the portfolio transformation. The explosive growth in defense and Homeland is more than powerful enough to absorb the shock from the health segment.
That's incredible resilience.
Furthermore, Bell provided some much-needed forward visibility regarding the VBA contract itself. Everyone was anxious about the recompete terms.
Right, the new draft RFPs.
The VA has signaled they will extend Leidos' current domestic MDE contracts for up to 6 months into mid-2027.
And according to the notes, they're also extending the international and pre-discharge exam programs for a full year, pushing those out through late 2027.
Which is vital because it completely eliminates the fear of an imminent fiscal cliff where the revenue just vanishes overnight.
It gives them a smooth runway.
Exactly. But the VBA contract wasn't the only thing Wall Street was sweating regarding health. There was a broader fear regarding government insourcing, specifically tied to the MHS Genesis system.
We need to unpack this because MHS Genesis is a massive piece of the federal health landscape. What exactly is it?
MHS Genesis is the new unified global electronic health record system for the entire Department of Defense. It tracks a service member's medical history from the day they enlist through their transition into the VA. Leidos just successfully completed the 10-year global deployment of this massive architecture, bringing it in on time and under budget, which is incredibly rare.
Very rare in federal IT.
Now that it's built, the Defense Health Agency, the DHA, wants to procure the underlying commercial software licenses directly from the vendors, effectively insourcing the basic management.
So the fear is the classic middleman squeeze.
Exactly.
The government used Leidos to build the house and wire the electricity. Now that the house is finished, they don't want to pay Leidos a premium just to manage the property. They figure they can just buy the software licenses themselves.
That is the exact fear analysts were voicing, but Tom Bell countered this brilliantly. He acknowledged the trend toward insourcing basic IT, but highlighted that the DHA simply lacks the internal manpower and the specialized technical capacity to manage complex integration.
So even if the DHA buys the software licenses directly, they still need Leidos engineers to actually make that software talk to hundreds of other legacy military databases securely.
Right, you can't just hand a software license to a military medic and expect them to integrate it.
Which is exactly why Leidos still holds the sole source bridge contract for MHS Genesis.
Yep, retaining the complex work.
And we shouldn't act like Leidos is suddenly losing its touch in health contracting anyway. The sources highlight some massive offsetting wins that barely got headline coverage.
Like the GSA Military One-Source contract.
Yes, a $456 million contract managing a 247 global well-being service for 4.7 million service members.
And they secured a $325 million extension from the DHA for the Reserve Health Readiness Program, RHRP 3.1.
Ensuring reservists are medically cleared for deployment.
Exactly.
So to synthesize this entire situation with the health segment, management successfully quarantined the drama. They proved the VBA incentive pause is a temporary administrative headache, not a permanent structural flaw.
And because that fear was neutralized, the market was finally free to look at what is actively exploding in value inside this company.
Which brings us to the astonishing numbers coming out of the defense tech segment.
Yeah.
Let's do a strict forensic audit of defense.
Organic growth in this segment accelerated to 6.2%. And if you exclude some legacy airborne programs rolling off, it actually grew at a double-digit rate.
But the headline metric, the number that screams structural tailwind, is the book-to-bill ratio.
It's an extraordinary figure. They posted a 2.2x quarterly book-to-bill ratio.
Let's define this conversationally.
Yeah.
A 2.2x book-to-bill is insane. It means for every single dollar of revenue Leidos recognized and billed to a customer today, they put $2.20 of new signed contract awards into the backlog for tomorrow.
Over the trailing 12 months, that ratio sits at 1.9x.
That is a massive leading indicator of future cash flow. But what exactly are they booking? Because this goes back to our Tony Stark analogy.
Right. They aren't booking thousands of IT help desk tickets. They are booking physical advanced hardware. They are transitioning from bending paper to bending metal.
The crown jewel here is a multi-year framework agreement exceeding $1 billion to deliver 3,000 low-cost containerized strike munitions by 2030. The AGM-190A sphere.
Yes.
Let's unpack containerized strike munitions. What is the tactical reality of this, and why does the Pentagon want 3,000 of them?
It's driven by military doctrine moving toward distributed lethality. Traditionally, you rely on billion-dollar destroyers or massive aircraft carriers to project power.
But those are highly visible, highly vulnerable targets in a near-peer conflict.
Exactly. If an adversary takes out one carrier, you lose an enormous percentage of your strike capability. So the military wants to launch sophisticated munitions from standard, low-profile shipping containers.
Which you can put on a commercial flatbed truck or a cargo ship. It turns everything into a potential launch platform.
And an adversary can't possibly track every shipping container in the Pacific Ocean.
But wait, if Leidos is historically an IT company, how do they suddenly know how to build a missile that launches from a shipping box?
Because the hardware is only part of the equation. The real challenge is the software. How do you network a missile on a truck with a targeting drone miles away and coordinate a simultaneous strike with a ship?
Leidos has the software architecture to make those non-traditional platforms communicate securely.
Precisely. And they estimate the total addressable market for these munitions over the next 10 years is a staggering $44 billion.
$44 billion. That's a massive pool of revenue. And the hardware wins don't stop there. They were selected by Sierra Space for the Space Development Agency Tranche 3 satellites.
18 satellites under the Golden Dome initiative. They're supplying the infrared sensing payloads.
Building the eyes in space. And the unbooked pipeline is wild, too. A $475 million contract for F-16 avionics.
And an $88 million MACHTB 2.0 contract for experimental hypersonic glide test beds.
Hypersonics. Flying at speeds current systems can't even track. And they are positioned for a Q4 production decision on the Navy's Medium Unmanned Surface Vessel, the MUSV program.
Autonomous warships with no sailors on board?
But this brings up a massive contradiction. If Leidos is building actual missiles and autonomous ships, they're competing directly with legacy hardware primes like Lockheed and Raytheon.
True.
Wall Street loves Leidos for their software-like low capital margins. If they start building factories to bend metal, doesn't that ruin their margin profile? Metal bending is notoriously expensive and low margin.
That exact debate is happening among allocators. Management was asked how they plan to scale this munitions business without destroying their capital light model.
And what did they say?
CEO Tom Bell confirmed they are rapidly expanding their manufacturing footprint in Huntsville, Alabama. Manufacturing headcount specifically is up 33%.
So they are pouring concrete and buying heavy machinery. How do they justify that?
Because they are applying a software development mindset to hardware production, they're focusing on low-cost, attritable hardware, not bespoke, billion-dollar stealth bombers.
Standardized modular systems where the real value is in the proprietary software.
Exactly. Which brings us to Operation Jailbreak, an Army hackathon that illustrates how they defeat legacy primes.
Break down Operation Jailbreak.
The military has a chronic problem with proprietary vendor lock. Traditional primes build a tank or a radar, and they lock down the software architecture with proprietary code.
So the government has to keep paying only them exorbitant fees for updates. The classic razor and blades model applied to national security.
It creates a nightmare where hundreds of different weapon systems can't communicate with each other. So at Operation Jailbreak, the Army challenged contractors to break that lock.
And
Leidos engineers didn't rewrite the code. They used secure, open APIs. They built translation layers that wrapped around the non-Leidos hardware, pulling the data out and integrating it seamlessly.
They bypassed the vendor lock faster than their peers.
They're proving you don't need expensive software updates from legacy primes if Leidos can just build a bridge over their walls.
That is brilliant. But building hardware and breaking lock is only half the battle. The real margin expansion happens when you inject proprietary artificial intelligence into those operations.
Which brings us to their intelligence and digital division. This division holds a jaw-dropping $12 billion 12-month proposal pipeline.
$12 billion in pending bids. And the strategic centerpiece is their new collaboration with CoreWeave.
Let's talk about CoreWeave.
They are one of the hottest names in AI infrastructure right now, backed by NVIDIA. What is a hyper-growth AI cloud company doing with a defense contractor?
They are partnering to deliver secure, sovereign AI cloud compute specifically for classified DoD workloads.
Because there is a massive physical and regulatory wall between commercial cloud providers and classified data. You can't just plug CoreWeave into a Pentagon database.
You need a SCIF, a sensitive compartmented information facility.
And for you listening, a SCIF isn't just a locked room. It's physically hardened, electronically shielded, air-gapped. No cell phones, no wireless signals.
Bringing commercial cloud into a lead-lined bunker is a massive logistical hurdle. CoreWeave doesn't have the cleared personnel or accreditation experience for that.
So Leidos is the essential bridge.
Yes. Leidos handles the mission integration, the rigorous cyber accreditation, and the complex data engineering required to operate CoreWeave's hardware inside those SCIFs.
Giving the intelligence community commercial-grade AI speeds with military-grade security.
And this allows Leidos to execute a massive structural shift in their business model, moving away from traditional cost-plus contracts and aggressively pursuing highly profitable fixed-price, outcome-based contracts.
Okay, let's use an analogy for this. In government contracting, a cost-plus contract is like paying a contractor by the hour to paint your house. The government pays for the paint, the labor, plus a guaranteed 8% profit margin.
It's very safe. You can't lose money.
But your margins are permanently capped. If the contractor figures out a way to paint the house in half the time, they actually lose revenue because they bill fewer hours.
Zero incentive for efficiency.
But in a fixed-price contract, the government says, we will pay you $5,000 to paint this house. Just deliver a painted house. If you invent an autonomous robot that paints it in 10 minutes for a cost of $100.
You keep the entire $4,900 difference as pure profit. Leidos is basically inventing the robot.
They're utilizing AI software to radically compress the cost of delivering outcomes.
A perfect example is Parkata, a model-agnostic AI platform developed by Kudu Dynamics, a cyber firm Leidos acquired. Parkata autonomously detects and patches zero-day software vulnerabilities in real time.
A zero-day being a flaw hackers found, but the software creators don't know about yet. Traditionally, how does the military deal with that?
You pay hundreds of highly cleared, very expensive cybersecurity analysts to manually monitor network traffic and write code to patch flaws. It's labor-intensive and slow.
But with Parkata, the AI does it autonomously. And in a fixed-price environment, Leidos keeps those massive labor savings as profit.
Exactly. They are also deploying cyber capabilities at the tactical edge. At the Valiant Shield 2026 exercises in Guam, they field-tested their Cyber and Electromagnetic Activities Resiliency System, or CRS.
What does it do in combat?
It successfully detected real-time intrusions across tactical battlefield networks. Imagine an adversary trying to jam communications between a Navy ship and a drone.
Right.
CRS uses AI to instantly recognize the electronic warfare intrusion, reroute the communications, and maintain the link without human intervention.
What fascinates me is how they deal with legacy government data. Ancient databases running on 1980s mainframes. You can't unleash modern AI on that.
No, you can't.
Leidos tackled this by integrating a platform called LDOS, built by the modern data company, into their own Headway Mission OS. The analogy here is like buying a state-of-the-art smart home hub, but your house was wired with copper in the 1970s.
Normally, you'd have to rip open all the drywall, pull out the copper, and install fiber optics. Ruinously expensive and risky. Tearing down a legacy database risks losing decades of intelligence.
But the Leidos software avoids that. LDOS simply overlays a connective digital tissue on top of the legacy data. It builds a translation layer that makes the old data instantly AI-ready. You get the smart home without tearing open the walls.
And they are aggressively deploying this AI-driven efficiency internally, too. They executed a massive internal deployment of ServiceNow's AI platform across their 50,000 employees.
The metrics on that are wild. They're targeting autonomous resolution of up to 80,000 internal IT support requests annually.
Currently, 60% of their Level 1 IT tickets are handled completely without human intervention.
Password resets, software access the AI, resolves it instantly, generating over $3 million in direct annual savings, dropping straight to the bottom line.
They're also pushing predictive AI into global logistics. They partnered with Rune Technologies to integrate TyroS for predictive sustainment in the Indo-Pacific.
Logistics in the Pacific is a nightmare, especially if communications are jammed.
TyroSo uses AI to analyze weather, troop movements, and consumption rates to anticipate supply demands before shortages happen. It figures out a base will need ammo next week and initiates movement before a commander even asks.
And they formed an alliance with DHL Supply Chain to execute the physical movement, combining Leidos AI with DHL's massive logistics scale. They're bidding on the UK Ministry of Defence's Future Defence Support Services program with this.
CEO Tom Bell confirmed that government customers are actively requesting these fixed-price transitions. The Pentagon wants the efficiency of AI, and they'll pay a premium for outcomes.
Which brings us to capital allocation. High-margin AI software plus scalable defense hardware equals an absolute fire hose of cash. Let's dissect the Q2 cash flow engine.
The cash generation this quarter was historic. Operating cash flow hit a record $793 million. That's a stunning 224% conversion ratio relative to their net income.
Meaning for every dollar of accounting profit, they generated $2.24 in tangible, cold, hard cash.
Incredible conversion. And their non-GAAP free cash flow reached $761 million, a 185% conversion ratio. This allowed them to raise full-year operating cash flow guidance to approximately $1.85 billion.
But the really interesting part is the low capital intensity model. Despite scaling up munitions production, they reduced their full-year CapEx target to roughly $250 million.
For an $18 billion revenue enterprise, $250 million in CapEx is unbelievably lean.
It's only about 1.3 to 1.5% of revenue.
It highlights the valuation difference between Leidos and legacy primes. Legacy primes need billions for heavy machinery and dry docks. Leidos remains software-heavy, so capital requirements are remarkably low.
If you take $1.85 billion in operating cash and subtract $250 million in CapEx, you get an implied free cash flow guidance of roughly $1.6 billion. That is an enormous war chest. How are they deploying it?
First priority was aggressive deleveraging. They fully paid off the remaining $300 million in commercial paper tied to the Entrust acquisition. Gross leverage dropped to a very healthy 2.5x.
Pristine balance sheet. What about capital return to shareholders? In Q2, they deployed $72 million towards share repurchases, exhausting their 2022 authorization.
And this is where management made a highly explicit signal. An analyst asked if they were going to execute bold share buybacks, given the stock's discount.
And Tom Bell and CFO Chris Cage didn't hold back. They basically said private M&A valuations are very expensive right now. Everyone wants AI and defense tech, and multiples are absurd.
They refused to overpay for acquisitions. Meanwhile, Leidos equity was trading at a massive discount after the health segment panic.
So they announced a brand new board authorization for share repurchases, explicitly telling Wall Street that aggressive buybacks are the absolute priority for the second half of the year.
Because everything else in the market is fundamentally overpriced.
I mean, a defense contractor generating $1.6 billion in free cash flow, slashing CapEx, and aggressively buying their own stock. Why isn't every allocator piling into this?
That brings us to our final verdict. Based on everything we've looked at today, Leidos is acting as an unassailable, high-cash conversion defense technology compounder.
They are the essential mission engineering backbone for defense and intelligence.
Wall Street consensus heavily reflects this. Analysts maintain a solid buy rating, with average price targets between $150.67 and $166.57.
And the high targets are reaching $195 to $225 per share. But to be objective, we must note the execution risks. What are the three primary risks allocators need to monitor?
First, persistent administrative uncertainties surrounding the VBA-MDE contract recompete. The terms are still unknown, so there's potential for structural margin resets.
Right. Second is macro-level political reality. Potential year-end budget disruptions under government continuing resolutions. Freezing new spending could temporarily impact that 2.2x book-to-bill momentum.
And third is execution timing risk. Winning a development contract for hypersonics or autonomous ships is one thing. Transitioning those into full-rate, profitable hardware production without cost overruns is a massive engineering challenge.
But even with those risks, you have to look at the structural safety net. They are sitting on a staggering $48.7 billion total backlog, with $10.2 billion funded.
Plus $23 billion in active pending proposals waiting for adjudication. That provides immense multi-year visibility and a buffer against short-term volatility.
This deep dive really proves that headline noise often obscures the deeper structural reality of a business generating immense cash. The market panicked over an administrative audit, ignoring the fact that Leidos is building the actual hardware and software defining the future of warfare.
Evolving from a legacy IT service provider into a true defense technology prime funded organically by a $1.6 billion free cash flow engine.
Which leaves us with a final, slightly provocative thought for you to mull over. If Leidos is effectively acting as the central nervous system for the DoD, providing AI, breaking vendor locks, and increasingly becoming the muscle too, building munitions and autonomous vessels, where does that leave traditional defense primes?
That's a great question.
If Leidos captures all the high-margin software and integration value through fixed-price contracts, do the legacy giants risk becoming just low-margin metal benders in the future? The entire hierarchy of the defense industrial base might be flipping upside down right in front of us. Let that sink in until next time.